we're like, look, over the past X number of cycles, when PMI decelerates, bonds do well. And it's like, well, sure, unless you have kind of a record spread between bond yields and inflation is still a problem because this is not the last few decades of playbooks. Now, if bonds blow out far enough, and they've already kind of exceeded what I would have guessed that they would have got to this quickly, there's a point where they're interesting. Especially the short end of the curve. If you want kind of risk
Hmm.
off dry powder, and you say, well, I mean, the yields are below inflation, but I'm concerned about recession. Those that can I think be a reasonable place to park capital. I'm also, I'm kind of cautiously optimistic on gold after, it's held up better than the long end of the curve. And I think when there is kind of a liquidity period, I think, gold can catch a bid while potentially, say, corporate profits are still struggling. And so you can get a bid in some of these harder assets that don't have margins, kind of the gold Bitcoin
Hmm.
spread compared to something like corporations that even if there's a Fed pause or pivot, they might still have deteriorating corporate earning situations. So stocks might run into issues, right? So there are different kind of things to look out for like that. I generally think that as long as we're in this economic decelerating environment, generally stay defensive. For me, it's been less about bonds and it's been more about things like healthcare stocks, energy pipelines, tobacco company, kind of consumer staple type of things. And that's been I've overweighted that. So I don't do like a fast turnover portfolio where I go all into just these things, but I've been kind of tilting to that direction since the beginning of this year, while still having a barbell approach of some risk assets that I like. Some of them were worked out, some of them didn't. So for example, Brazil has been one that I've been overweight Brazil. That one's done quite well. Whereas, for example, I also have a Bitcoin allocation that is, it's been holding up recently pretty well, but obviously earlier this year that's done quite poorly. And so I've been balancing kind of a risk off defensive, higher yielding type of portfolio with some degree of inflation protection built in. And then, kind of select risk assets. I like India, I like Brazil. Long term, I like Bitcoin, but I keep reminding people that generally in a declining PMI environment, it generally runs into headwinds. So if you look at the global financial crisis, you had one of the worst recessions in modern history, and oil demand globally, even though so the price of oil got crushed, right? Actual oil demand only fell very little, right? So normal outside of the madness of like 2020, where we had this completely historic event, huge cliff in terms of oil demand. That was a very specific outcome. So putting that aside, even a severe recession only puts so much downward pressure on oil and gas in terms of the quantity that is used. Now the difference was in the global financial crisis, you had a whole decade of more and more supply coming online. And you went from super cheap oil up to $140 barrels of oil at one point, and then you crashed down to some crazy level. And then actually after a recession, you quickly went back up to over $100 barrels of oil. In addition, back then, oil companies were kind of expensive relative to the underlying price of oil. What makes this environment different is that oil companies are still not expensive relative to these prices. So there's a lot of pools of capital. They're not even allowed to invest in oil companies. Other ones kind of everyone has the same thesis, which is, this can't last. So the idea is like, they're so uncertain about oil prices, they don't want to own these energy stocks. And so in addition, we've not had much of a new supply cycle over the past, say, 5 years. So ever since oil fell off a cliff in 2014, there's been a sharp reduction in capex. Um, OPEC is kind of, arguably out of spare capacity. Um, and so I think that there's the supply side, in my view, somewhat more important than the demand side. And then especially when we get to a point where the United States is no longer drawing down its strategic petroleum reserve, right? So that's essentially a new form of demand if that just stops going down. Um, and if China ever decides to come out of these rolling lockdowns, there's good data showing how significantly they've been holding down flights and then probably also automobile usage, right? So different types of fuels in China are well below their baseline already. Um, in addition, this is where oil prices are with the dollar going straight up, right? And so
Hmm.
imagine if that just even not just falls. Imagine that just stops going up at the same pace it has been. It just kind of levels out for a period of time, especially in a number of currencies. If they pause, let alone pivot, if they just pause or they have to reliquify something, right? And if you get some sort of local top in the dollar, who knows what could happen to the dollar price of energy. And so I do think that there are reasonable concerns over the next 6 to 12 months about the sector. I think it's going to be a volatile ride. I would not be levered long, small cap energy producers, right? Because I think you're going to have a bad time if you do. But I'm structurally long with a multi-year view and uncertain enough about that tight supply demand dynamics. There's multiple headlines I could wake up to that would make me either a little bit more bullish or a little bit more bearish on oil over a 3 to 6 month period. Um, but it's something that I'm willing to unlevered hold through this period of volatility because I think the underlying situation is very, very different than say the 2000s decade. So there's been no supply cycle yet, and there's only so much demand that can come off the market, and there's all these temporary forces that are already kind of artificially suppressing it as it is. So I look at things like price to cash flow over a multi-year period. I also look at things like like dividend yields for these large caps because earnings change a lot more rapidly than their dividend does, right? And so generally in this environment, last time you had that huge uptick in oil and you had a huge uptick in these energy companies. And right now, for example, they've been, most oil companies are like their stock price is like down or sideways, over like a 15-year period, right? This is not some sort of
Mm.
bubble in energy equities, right? So even though they're raking in profits, they don't have exposure to much globalization, right? So they don't have to worry about like Chinese supply chain issues. Um, they have basically good dividends, good cash flows. Many of them have stronger balance sheets. And so I generally find that a lot of them they've not kind of reflected the idea that oil probably has like a floor in the say 70. Doesn't mean it can't briefly go below that, but there's a pretty strong bid by either OPEC or the SPR once you go below 70. While the upside is who knows what the upside could be. I mean, oil prices could do what natural gas prices in Europe did, and it's unclear. And I'm talking about like say a 5-year period, right? And so I think that the upside of energy prices is much bigger than the downside of oil prices, and that they're kind of pricing in something along of this like lower end of that range as though that's going to stay there forever, or even go down. And so, for example, I look at Morningstar analysis of like energy companies, for example, and they'll generally assume like a return to the prior 5-year baseline of oil companies, which if, I guess that's
Mhm.
fine. That's conservative, right? So you're valuing the company based on that, and that's a good thing to do. But then it's like, okay, what if that doesn't happen? What if you don't go back to 60, 70 oil? What if the new normal is $100 oil, or what if the new normal becomes $120 oil, which again is still below the peak price you reached before the global financial crisis, let alone the fact that the inflation adjusted price. So it's not even extreme energy pricing at that point.